I'm not going to lie to you, I went to Park Life on Sunday and I am still feeling it now. I would say that I'm getting too old for this sort of thing, but the truth is, I've been too old for about 6 years. But anyway, I wanted to make a quick video today to talk about the Celsius situation, mainly because I've spoken about BlockFi before on this channel, which is a similar service. And I think it's important just to take a look at what's going on here and kind of uncover what the reasons are for them shutting their doors and the apparent collapse of their service recently. Let's just start with, what is Celsius? For those who don't know, Celsius positions itself as a sort of bank within the crypto space. So it's a lending platform. You can deposit your cryptocurrencies on there. They will then provide you a return on that. And their job is to go away and find ways to generate a return on cryptocurrency. That means they can pay you the promised return and leave them with profit as well. The key thing is here, the rates on offer. They promise pretty high rates, some of the highest rates in the space. If you compare that to a traditional bank, you see just how high that is. Most banks still pay under 1%, even though interest rates have risen, so savers aren't seeing that rise in interest rates, but the banks have been happy to put up the cost of mortgages, haven't they? I mean, even NS&I, the government-backed saving company, have increased the rates on premium bonds to 1.4% in a reflection of rising interest rates. It seems like banks want to charge you more for loan products, but don't want to pass on the gain to savers. So it's no wonder that products like this with Celsius have become so popular. Celsius reports that it has about 1.7 million customers, about 8 billion lent out to clients, and about $12 billion in assets under management. So what has gone wrong? Celsius has removed the ability for people to take money off their platform, frozen transfers, and then given the typical BS of it's to protect clients' assets due to unusual market conditions. What they mean by unusual market conditions is crypto's having a bad time at the minute, but so is everything else. Stocks are all down, as we know. Crypto feels it a little bit harder, yes, but generally assets are down all over the show. Now, we're going to get into the mechanics of why Celsius have got into this mess in a second, but I just want to say, first of all, with cryptocurrency and unusual market conditions, take a look at this chart. This chart shows the price of Bitcoin since its creation, which is a good measure on the overall crypto industry. Yes, it's down at the minute, but is this really unusual market conditions? I would expect any platform like Celsius to be correctly positioned in order to weather large drops in crypto valuations because, let's face it, they happen all the time. I actually find this message of it's to protect clients as borderline insulting, and what I'm going to show you now is how Celsius have essentially backed themselves into a corner. So when people describe these crypto lending platforms, they will typically say that they take your crypto, lend it out to clients, and give you a portion of the interest. In reality, behind the scenes, these lending platforms are engaging in complex strategies to generate yield on the crypto you deposit on their platforms. And with Celsius, because they promised some of the highest rates in the market, they look to have been engaging in some of the more out there strategies to generate yield. It's rumoured they lost loads of money in the Luna collapse and with the Anchor protocol. If that's true, and they did lose a load of money in the Luna situation, it kind of shows their attitude towards risk with other people's funds. I'll pay you 9%, you just give me a crypto, I'll then go stick that in an algorithmic stablecoin that promises 20%. For me, anyone who works within the crypto space, who positions themselves as an expert and is taking money off people to then lend it out, should understand the risks of algorithmic stablecoins. I've never seen one that's worked long term. It's akin to just putting people's money into like a Ponzi scheme of sorts. Now, I haven't found any sources that have confirmed if that is true or not. It's just rumours at the minute. But one thing that is true, one thing that we can see and prove, is that Celsius have issues with something called staked ETH, or ST-ETH. We won't get too deep into this, I promise. But essentially, ST-ETH, provided by someone called Lido Finance, is a staked form of Ethereum, pegged to Ethereum. And really the theory is, I would give you an Ethereum, you would then hold a staked Ether, an ST-ETH, and I can use that as collateral to borrow crypto or to farm for liquidity, etc. It's kind of like if you came into a shop and said to me, Damien, here's 10 quid. I'll say, okay, I'll put 10 quid in the safe. You can then take 10 quid's worth of stuff out of here, and when you return it, I'll give you that 10 quid back out of the safe. The idea is that when you stake that ETH and you get the ST-ETH, it's locked away, but you can always redeem that for one Ethereum on the other side if you wanted to. Celsius have a lot of this ST-ETH. Larry Kermack, the Block's VP of research, shows that Celsius holds around 409,000 ST-ETH, which is worth around $463 million. So they've taken clients' crypto deposits, converted them into this ST-ETH, and locked it away on the understanding that they could then convert that back to Ether at any point if they wanted to provide liquidity. The problem is the price of ST-ETH has depegged from Ethereum. CoinMarketCap shows ST-ETH is trading around $1,172, whereas Ether is trading around $1,240 at the time of recording this. So your 10 quid in the safe is now only worth 9 quid. This depegging, this delinking of this pair so they're not worth the same thing anymore has caused panic, and people have rushed to sell, which has caused the price of cryptos, especially Ethereum, to collapse all over the show. And Celsius now have this really difficult position where they've got like 460 million quid in this staked Ethereum, that if they convert that back to Ethereum, it's worth less than what they put in, essentially, because they're not getting fair value swap anymore. Also, if they sell loads of that staked Ethereum, they run the risk of crashing the price further broadening the gap between the peg. Remember, it's not 1 for 1 anymore. It's about 95% to 1. Now, really, this would only be a problem if lots of people wanted their money back from Celsius at the same time, as that then forces Celsius to cash in this ST-ETH at a rate below what they need it to be. The problem is, that's exactly what's happened. And here we have the run on the bank. So we all saw that Luna went down a few weeks ago, taking billions in people's assets with it. And I think at that point, people started to think, hold on, these so-called guaranteed returns that are being promised by these platforms don't seem that guaranteed anymore. And I think that generated a lot of concern around Celsius. So people at that point started thinking, is this really the best place to be keeping all my money? And I think while a lot of people practice diversification, there's stories emerging of people just being all in on these platforms. I don't want to lecture people, but we should practice diversification across asset classes and across platforms, especially within unregulated spaces like crypto. It just is very ballsy to have everything you've got on a platform that if it goes down, there is no regulatory protection for you at all. The Luna thing got people worried. At the same time, red flags started emerging around Celsius. The company's chief financial officer was charged in Israel for being involved in a huge crypto scam in the past. The guy that handles the cash was charged with fraud for stealing people's crypto in the past. It's just not a good look, is it? Celsius was also hit with a number of cease and desist orders from different states in America and was told to stop selling its primary investment product, as the regulator in America believed it represented a security and needed to be regulated as such. Now, I want to be fair here. This issue affected a number of different players in this space. Coinbase scaled back their ambitions around an interest-backed account on the basis that it became clear regulators wanted it to be treated as a security. And BlockFi, who, like I said, I've got a little bit of money with, they were hit with a £100 million fine and told to stop selling their interest account in America. I honestly think that a bit of this is a cash grab from the regulators. These accounts and these services have existed now for years and the regulators have done nothing. And then at a time, America probably needs a load of cash. They're like, all these interest accounts. I tell you what, go in, fine them and say, if you want to keep offering your services, you've got to pay 100 million quid fine and then go through regulation. I want them to be regulated. I just want to be clear on that. I think they should be regulated. But I do think the 100 million fine makes it sound a lot worse than it actually is. It's more just like, a shakedown. But regardless, it was just more bad headlines for Celsius. There were also some other minor points that hit the headlines. For example, one of the senior directors used to be involved in the adult entertainment industry. I'm not sure what the problem is there. People concerned of a different type of pump and dump, I don't know. But it just, again, raised concerns about the Celsius platform and people started to get jittery and they started to take their money out. Between March and May, $1 billion left the platform. It then became public knowledge that Celsius was taking out loans to essentially pay people out of the platform. So rather than cashing in crypto assets like the staked ETH that was now worth less than it should be, they were borrowing money from other platforms in order to pay people out. Celsius withdrew 50,000 Ethereum and 7,000 wrapped BTC after receiving $169 million in USDC from FTX. FTX is that crypto exchange that just appeared to sponsor every single channel on YouTube at the minute. Well, apart from mine. They were set up and are run by that guy Samuel Bankman-Fried. He was born in 1992 and is worth $24 billion. I mean, if that doesn't make you question your life decisions, I don't know what will. Do you want to be a billionaire, Damien, or do you want to stand in a wet field in Manchester somewhere listening to Bicep on a Sunday? Bicep every time. It looks like Celsius have been sending FTX crypto in exchange for dollar-backed stablecoins in order to keep up with demand from clients to take money off the platform. all because they've locked too much of clients' assets away in things like staked ETH so that they can generate the high yields that they're promising to clients. But now that that's depegged, they have no ability to cash that in without risking further collapse in the price. So they need to borrow money from elsewhere in order to keep up with the payouts. If all this was happening behind closed doors, it would likely be fine because people wouldn't be able to see that transaction happening. But because we can see the transactions on the blockchain, and because people like Dirty Bubble Media are reporting on these transactions, this borrowing from other platforms has got people rightfully spooked because they're like, what do you mean you've got to borrow money from FTX in order to give me my cash? Give me my money back. Those of you who are old enough will remember the run on the bank on Northern Rock in 2007. Basically, Northern Rock went to the Bank of England and said, we need help. We haven't got enough cash because we've irresponsibly lent money out to people, essentially. And when the news broke, everyone rushed to the bank and there was queues around the block with Northern Rock because people wanted their money out of the account. It just made the problem worse because Northern Rock didn't have enough cash to give everyone. This is an example of the same situation, but instead of a bank, we have Celsius, and instead of the Bank of England, we have FTX. So Celsius have now shut the front doors to essentially stem the bleeding and stop people withdrawing so much money off the platform because they simply don't have the cash to pay out. They've probably got the value locked away in assets like staked ETH, but they can't cash that in easily to pay people out. They're now going to be looking for ways to secure liquidity so that they can open up the doors and resume business as usual. They actually raised 750 million late last year. I question where all that's gone. Hopefully not to Luna. But the issue we have is, with a bank run, when you shut the front door and stop people from being able to take their cash out, inevitably, when you open back up again, you get a bank run. Because rightfully so, loads of people are going to be like, I just want my cash off this platform. I don't trust what these guys are doing or what they're saying. As soon as you say to someone they can't have their money back, people want their money back. Especially the other day when the creator of Celsius was sat there saying everything's fine and peddling an 18% return product. There's no quick way back for Celsius, in my opinion, here, because as soon as they open the doors, there's going to be a run on the bank, I would bet. It seems that in order to maintain their higher than average returns that they've promised to everyone, they've gone into riskier and riskier strategies and haven't practiced good allocations in terms of liquidity. They should be keeping enough money on side to pay people out. On balance, though, I don't think this is the same as a Luna situation because this company has major financial backers and also relationships with platforms like FTX that appear willing to sell to them, or to lend to them, sorry. And as well as that, there are still assets there that are locked away. It just yet to be seen how they're going to access those. The question now is, how much of a mess are things behind the scenes? Does Celsius have leveraged positions or margin calls that could sink them? Are there any skeletons in the closet? What needs to happen is the regulators need to hurry the hell up and regulate these businesses properly. Because while there are promises of 20% guaranteed returns, and while there is absolutely no oversight of an industry like cryptocurrency that's worth over $1 trillion, right? People are just going to take the mick. Customers are going to put their money in those products because to them, on paper, it seems legit and they see their friends making money. And then those platforms are going to just take more and more risk until it just blows up in everyone's face. The regulators need to protect consumers. How many times are we going to sit here and go, another one of these platforms has gone, taking billions of pounds or dollars with it, before they step in and go, right, let's fix this mess. Until then, please realise that 20% returns are not normal and will never last in my experience. Just please tread carefully around this space. In my opinion, cryptocurrency should form only a small part of your asset allocation within your widely diversified portfolio. And then the money that you're sticking onto these, YOLO bet 20% interest rate things should form just a fraction of what you invest on a month. It should not be your main thing. I know the returns are attractive, and I know for a lot of people sat there now, they'll have made bucket loads of money. But when it goes wrong, it happens so quick and it just takes everyone with it. If you're sat there now and you've been hit by Luna, or you've been hit by Celsius, or even if you're just someone that's all in on quite a speculative, high interest crypto, I would seriously ask you just to consider your asset allocation and think about whether you can afford to lose all that money at once, because that is a real risk, as we're seeing at the minute. There is no such thing as a risk-free return. These companies might promise it and you might not see the risk, but behind the scenes, they are taking risks with your money in order to generate the returns that they need to pay you. If they're promising you 10%, 15%, 20%, what kind of risks do they have to take to achieve that return when the average rate of return of the stock market is 9% a year? Just understand there is no risk-free returns in this world. There is no juice without the squeeze. I wish I had some actionable advice for people who've currently got money trapped in Celsius, But the truth is, we're kind of just at their mercy at the minute with this. I really hope that they sort things out, open the doors, and provide enough liquidity to cash people out at the same level that they put money in. And, you know, this doesn't continue to get worse from here. If you are struggling with this at the minute, reach out to me in the comments or DM me. I'm happy to chat things through. You know, I don't want people worrying at home about this, so come and have a chat to me. And thank you, as always, guys, for listening. I'm going to go to the shop now, get a load of food and a bottle of Capella. Give me a product to me.